Es un placer saludar a Massimiliano Bondurri, él es fundador y CEO de SGMC Capital. Massimiliano, thank you so much for having us a few minutes.
It is my pleasure.
Massimiliano, at this moment we remain focused on inflation. Could it be temporary as central banks repeat?
But what we're seeing now is inflation is extremely high because of three main factors. The extremely accommodative monetary stances across the globe of most central banks. Of course, a very high demand because of coming out of COVID, there's been a lot of pent-up demand. And at the same time, a bit of a supply shock because we've been seeing that in terms of production, in terms of just overall supply chains, they're being disrupted. So all of that, what it creates is inflation. We've seen 6.2% print very recently, and it's going to remain high. We don't think it's going to remain as high as 6% in the medium term. With medium term, I mean the next 4 to 6 months, because eventually the supply chain issues are going to be solving themselves. But definitely it's going to remain higher than the 2.5% that the Fed and other central banks normally target. And therefore, that will likely is going to be creating some issues for the Fed and central banks going forward.
Federal Reserve will start its tapering later this month. Meanwhile, we are expecting to know who will be the next Fed's chair. Biden is still deciding whether to reappoint Jerome Powell or replace him. Which are the main expectations?
Well, as of now, we've seen some of the Democratic big names coming out not in favor of Powell. But as of now, I would say it's a bit of 50-50. But clearly, it's not going to be a huge change in terms of what the Fed is going to be doing over the medium term. The proposed new candidate in place of Powell could be a little bit more dovish. But in general, it's not going to be changing quite a lot in terms of the messaging of the Fed, which has been extremely clear with respect to the fact that the tapering is not going to start, likely to finish around mid of the next year. And then from then only, you're going to be starting to look at potentially interest rate hikes. But whether Powell remains or not, that's likely going to be only a minor change because the narrative is going to remain very, very similar.
Let's have a look into European markets. Which are the main forecasts and concerns as we are closing this 2021?
Well, we've seen European markets being supported into the year end, and we expect this to continue right until end of December. That's because normally in the last month and a half of the year, you're unlikely to see a big trend inversion. And keep in mind that the numbers that some of the European corporates are coming out with are, of course, encouraging, and we're seeing more and more demand. Now, clearly, that being said, valuations are a little bit stretched, so one needs to be cautious at the same time. And the three main risks, given that you said what the potential risks could be, are clearly what definitely a potential raise again in COVID cases, but we think that's not going to be so likely. But it's really going to be in terms of this supply chain disruption. So what we're seeing now is that you've seen it very clearly in the semiconductor space, but also in the number of other industries. There's really disruption in terms of the supply. So it's hard actually for the demand, which is very high, to translate into actual purchasing because of problems within the production. Therefore, that could be the main issue for markets going forward, because if it remains, of course, you're going to be seeing a bit of bottlenecks and not so much this demand translating into growth. Geopolitical risks remain, especially political ones also within Europe. But overall, until the end of the year, we expect the markets to remain supported. And then next year, we're going to be probably turning a little bit more cautious, even though relatively positive.
And Massimiliano, which are from your point of view the primary threats of economic expansion?
Well, as mentioned, these supply chain bottlenecks are number one, definitely, which clearly spill into the semiconductor space. That's definitely going to be one. Normally, these tend to be solved over the next 4 to 6 months in general in the past, but that clearly cannot be said because you have a number of COVID issues as well, a number of geopolitical issues with respect to the free movement of people, labor, and products. So that makes it a little bit more complicated this time around. And then clearly, global geopolitical tensions can arise at any point in time. We have seen it in the past, and we have seen a number of headlines, especially coming out of the US-China relationships, even though recently seems that those risks may be waning a little bit. But overall, those risks need to remain at the forefront of global investors' minds and one needs to account for them whenever undergoing their asset allocations.
In terms of company earnings, what should we expect for annual results?
Well, the earnings that we have seen so far have been very encouraging. The numbers have actually been strong. Overall, we've seen quite a healthy beat in terms of the expectations. Now, on the other hand, in terms of guidance, a number of the companies have actually guided lower. We are going to be seeing whether that's because of being extra cautious because of the risk that I just mentioned and the supply chain disruptions, or whether really they're expecting demand to decline over the next 3 to 4 months. We think demand is healthy. It's going to be remaining, but clearly the numbers that we have seen this year are unlikely to be repeated, also because they were coming from a very low base of 2020 because of COVID. But overall, we always tend to focus on the companies which can keep healthy margins, can keep a decent growth rate, and they have actually been not disappointing over the last few years. And that's likely to continue, especially when you look at the technology space.
Massimiliano Bondurri, founder and CEO at SGMC Capital, thank you so much for having us.
Thank you.